Good morning once again. Today is the 30th of September. This is the end of the month. We're going to close this month, Nour, and we all know that the closing of each month is something very important for the traders because it's going to indicate the next move for later on. We've noticed that the dollar index is still trading at the same levels. We're still trading around the 100.38. It's a bit to the low, but still nothing major that happened since the last news. And we know for a fact that after today, for the whole week, it's going to be the national day in China. So low liquidity, they will be on holiday. This will affect the market. But at the same time, we've noticed the rally and the move for the stocks over there. And it's been booming. And eventually, it's going to affect the European market and the US market. Do you think that... or do you agree to the idea that basically China leads when we open the market, especially at the beginning of the week, and then the rest follow? So it's not the US leading at the same time.
I mean, but at this stage, of course, because of all the measures that was announced, at least during last week, we had the central bank announcing multiple stimulus measures, including cutting rates. Basically today, also at the beginning of the session, this is a record turnover for also Shanghai by more than 340 billion in one day. So this is basically in addition to that, if you look at the numbers that we've seen this morning, the manufacturing PMI came in. I wouldn't say like better than expected, but it was expected to shrink toward 49.4. It came in at least higher than that. Well, 49.5, 49.8, I think. And this has basically eased the market kind of worry about how fast the slowing down in China is going, and this is basically why also we've seen the majority of the Chinese stocks going higher. If you look at the Hang Seng or Shanghai Composite Index, they're all back up. At least Hang Seng, it's now up more than 35% from its lows of at the end of last year, which basically continues to tell you that despite all the pessimism towards China, the stocks is actually doing much better than before, and the intervention, or at least the stimulus package that was announced by the government and through the PBOC, is basically telling everybody, you need to calm down. Even though that we have a slowing down, we will be able to handle it. We will be able to intervene, and we'll be able to manage it.
Yeah, they're showing some muscles, but is it like now? Have you noticed something like the central banks are moving into a different direction where they are accepting the fact, or they are at least giving us the hint that we have kind of like the inflation is coming back and we need to fight it, or we are fighting it for you. So relax, but at the same time be careful. So it's like that message that we're getting from the Fed. But what I wanted just to understand, or we want to explain to the traders out there. Now, with the rally that happened in China, we can still take advantage in the European session and in the US session, well, at least in the same direction for a very short term to take advantage of the market. Now, let's talk a little bit about that and the dollar yen, because we've noticed dollar yen, it's near the weekly low. We're not there yet, of course, but we are near the weekly low. We're trading at the moment at 142, and we know that 141.70 was a decent support before. So any close below that, we're gonna retest the levels of 139.5, and then after that, 37.80, the same levels that we discussed before.
True. I mean, China will be leading basically today, I would say, and yes, there's a possibility that we continue to, or it will continue to influence the rest of the world, at least. Not to mention, but at the same time, you have to keep an eye also what is going on in the Middle East. That might be also one of the biggest risks that is hovering around the market, at least for the time being, if there's no more escalation more than what has been done during the weekend or the past few days.
But yes, it could affect the stocks.
It all depends.
Will affect stocks.
It all depends. I think if it expands more, because now the risk of a regional war has been at at record levels, never been seen before, I would say. So if that happened, yes, there would be at least, definitely, I would say, there would be a risk on all kind of possibility to see a notable sell-off across the board, yes. But on the other hand, also I mean, this is not something new, but what's new if it actually expands more than what we've seen it before. That's on the one side. So still there is a possibility to see the rest of the world following what happened in Asia today, at least when you look at the indices, even futures today, despite the fact futures at the beginning of the Asian session today dropped, at least in the US, a little bit, but now we're kind of managing. So that is from one side. Dollar yen, it's kind of like a different story because now we will have a new prime minister to lead going forward, and he is known as even more in kind of like decision making because he's also he's the former defense minister, and this at least was translated by the market that he might be more tough when it comes to the policy. So that's why we've seen the Japanese yen soaring back up. We're talking about dollar yen going down towards 141, and there might be going forward, we might be basically getting very close to stabilizing below 140. That is a possibility, but this is still based on the expectations of what this prime minister
soon, I think,
will do.
To decide here. But actually, I'm glad that you mentioned something regarding the geopolitical tension. I don't believe there's a very direct effect. It might affect, but it's not a direct effect on the major stocks or on the US stocks in particular. But what we've noticed is that gold opened on a very small gap and then covered it right after. So now gold is trading at the moment. We're looking at the levels of 2,657 at this moment. We opened on a very tiny gap and then we closed it literally after 3 hours. But there is two sides of the story here, two sides of the coin. So some would say that with the current problems that are escalating in the Middle East, this is the end of it. And some are saying, but we cannot deny the fact that Iran is going to interfere or do something. So there is a risk on to let things just get blown away. But we've seen Iran reaction before. Regarding the different assassination that happened and different issues that happened in this region, and there was no reaction. So the market is overreacting again. But despite this, before the assassinations happened, we've seen gold going up. So that wasn't the reason. So let's focus on this and explain that to the traders. That wasn't the reason why gold was going up.
No, but it wasn't basically because of what's happening. The reason, as much as it's also not to mention, the dollar weakness that we've seen. Plus, we're still seeing a notable inflows in a lot of inflows in gold and commodities in general. If you look, also silver finally broke out over 32, at least last week. Finally, so I think gold from.
We couldn't hold it.
I'm hoping that we could basically continue with this move. Although, I mean, you can. We've seen also on Friday, despite the data that we've seen from the US, gold was struggling to go up, and then we basically ended the day or ended the week slightly lower. So I think this week it would be more clear. I think also not to mention or not to forget also that today is the end of the end of September trading. So we would be expecting some sort of a notable moves, and as long as I think gold continues to post a new monthly high, I think there is no reason for us to change the bullish bias.
It's not going to change much. If you look at the monthly chart, it doesn't matter if it closed here or $10 below or $10 before. No one cares.
This is why I would say it is too early to start thinking about where is the top in gold. Especially also with the tensions in the Middle East, also with the continuous I would say dollar weakness at these levels without moving even lower. This still would give more chance for metals, but I would still say to the traders, just try not to chase the move, because again, this is record high. It could be the same or similar to the scenarios that we've seen back in 2011. That is actually possible, but try not to be, not to get stuck in a trade where you are basically buying the record high.
Exactly, and because you mentioned getting stuck in a trade, we've talked about oil a lot lately, and we've talked about the supports. Let's say US oil. We've talked about the support of 72. We've talked about the 67, and then we've talked about the 65.5. And now we're seeing oil bouncing back from the 65 all the way to 69 again. We touched the moving average last week or in the previous week of 73 almost and a half, and now we're back down. Is the market still insisting on the same fact of the growth, that there will be no growth in the next period in Q4 and 2025? And this is why we're still pricing these. Does the market not feel the tension that all of these wars are happening literally around this area where literally oil is very important?
I mean,
and
unfortunately,
any crazy missile can change the whole can change the whole game and can change the
I don't
whole
think so. I don't think
pricing.
so that one missile would actually change the whole thing. But it is very clear what oil is basically telling us, and this happened before. Oil is always, again, is basically pricing in or telling us basically by going down this much, despite the fact of the risk of a regional war is actually now very evident more than ever. But oil is telling us that the risk of growth is much stronger than the risk of war, or this is basically what matters. What matters the most is the risk of growth, and not the risk of war. At the same time, last week there was an article by the FT saying that that Saudi Arabia might be willing to abandon their target when it comes to oil prices at $100. In exchange of keeping or increasing their share in the oil market. So this is still, I would say, still something to keep an eye on regarding the geopolitical tension. But at the same time, this would be effective if we basically get a regional war. Hopefully not, but if that happened, yes, it might change. Otherwise, I think still oil will be continue to price in the risk of recession. Don't forget, the bond market is still telling us the same thing, or the same story in the US, that a recession might be coming. Now, the question whether if it's a soft landing, hard landing, it doesn't matter at this point. What matters is basically risk of growth is still here. The risk of growth is more important for oil than it's more important also for when it comes to the regional war or geopolitical tension at this time.
So let's wrap it up and talk as in our last subject about the euro dollar. Now, I can see that the euro dollar, if we close on the monthly chart, I'm talking about the monthly chart, above 112, that would be amazing for the euro dollar. That would be a decent indication, because eventually as well, we crossed both moving averages if we trade above 112. At this moment, now we're still trading at I don't know, 1160, something around that. So okay, I know that the trend is still up, everything is still up, but what if euro dollar does not close above 112 and we close around the same levels? On the weekly chart, we can see that there is some kind of consolidation. We're not able to break the 112 until this second, and there's no proper push or a technical indication that this is going to be good for the buyers. What is the fundamental part that can give me that strength to continue with the rally?
The fundamental part would be if the markets are basically going to start pricing in more rate cuts by the Federal Reserve. Now, it is basically one of the reasons why the euro did not actually break above 112 is basically because the increase of the estimates that the ECB will have to cut even more in the next meeting. At the beginning of last week, estimates were for another 25 basis point. Sorry?
They already promised.
They did not. No. They did not commit to any timeline. But they also said we're open both ways. But the markets now, after last week's data from Germany, inflation from Spain and Italy, basically it increased the odds of possible rate cut in the next meeting from 15% chance to 60% chance. So this is why basically the euro did not break that one spot 12, at least for the time being. So what we need now from the other side, from the US, for the data to keep confirming that we might be basically getting more than a soft landing, that would increase the odds for more than 50 basis point rate cut, or at least 75 basis point rate cut from now until the end of the year. Don't forget, we have the jobs report this week also from the US. That might be another catalyst, but as long as you know, the odds, or as long as the markets are expecting more from the Fed to cut this year, more than the ECB, the euro would still be supported with some sort of short-term retracements.
All right, so guys, we've been updating you about the market. If you have any questions, you get back to us. Keep in mind, again, low volatility in China. Be careful with your risk management, and we'll see you next week, which is as well next month.
See you next week.